Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
If you're interested in learning more about setting up your own family banking system, send an email to thefamilybankingshow@gmail.com. We'd love to hear from you.
Welcome back, ladies and gentlemen, to the Family Banking Show. We are your hosts, Derek, Rob, and John. Guys, let's not talk about weather, but how's everybody doing?
The weather's great. 55 degrees.
My non-weather thing I'll say is I had Cuban food today for lunch. Met up with someone, and I am Cuban. My dad was born in Cuba, and I grew up on probably 4 or 5 days a week eating Cuban food with my grandma, and it was just a taste of home. Not many good spots here in Minnesota, honestly, but a couple. And yeah, we're recording right now in the afternoon, and I was like, I am gonna be like sleepy if I don't have. So then I got the Cuban coffee with like a pound of sugar probably, and I'm wired, ready to go, and it's also a beautiful spring day. So
Good.
spring light.
Yeah.
for
And
day.
so John, that was actually a pretty good in terms of Cuban food in the area. That was a pretty good spot.
Yeah, super good.
Yeah.
Have to give it a shot sometime.
Yeah. Yeah, we'll have to meet up there for lunch.
Yeah. All right, guys. Well, hey, this week we are dealing with a fundamental question that I think a lot of our clients ask, and rightfully so. It's a good one. And that is, why would I want to borrow money from myself? And that's often how infinite banking or family banking is peddled, is when people say that you can borrow money from yourself. So John, why don't you kick us off, talk about the concern, and then Rob, maybe go into, let's get technical about what it is that we mean here.
Yeah, so this is something I asked. I know, Rob, you were saying that you asked this question when we were discovering IBC and vetting it and making sure the strategy works short and long term. And this is a fundamental question that comes up often, right? You're saving your capital, you're storing your dollars in these life insurance policies that have upfront liquidity, that have long-term benefits, and we can go ad nauseum about the benefits that come with it. But then when the time comes and you're like, I got this nice cash value, call it 50K, whatever it is, and you want to access it, whenever the conversation or when part of learning the strategy in infinite banking comes that you say, okay, now your means of accessing it is to borrow against, that raises red flags. And that raised red flags for me because now I'm thinking, I don't want a loan on my balance sheet. I don't want to pay interest back for something that I worked hard to put in an account to save for, right? And that's reasonable. And I absolutely understand the thought process and where that comes from. But I think this episode should be super helpful to understand the broader context and why that's actually a good thing and why you now are in the position of strength rather than a position of trying to catch up, right? And so for me, what kind of changed it is a couple things, right? Compared to what is a really helpful and powerful question. And we're not comparing it to anything but a traditional savings vehicle, whether that be your mattress or a savings account. For most people, it's probably a savings account, right? And either way, like the behavior, I think like money is a behavior more than it is math. And the behavior of like saving up is the same, right? Whether you're doing IBC or the savings account or your mattress, building up your savings is the same behavior. And then accessing the funds, whether it be a withdrawal from a savings or borrowing against your policy, is the same behavior to be able to use those dollars. But then, like, the big question comes is what is the difference of the follow-on actions, right? The behavior of then building back up your savings account is the same, but what's going on in the background? Well, your cash values in IBC, your cash value is growing at this guaranteed rate at the full amount. By the way, it's getting tons of other benefits like a death benefit protection, disability waiver premium, and so forth. And that list goes on and on. And by the time that you're done, repaying yourself or building back up your savings account, at the end of that cycle, you're way further ahead in IBC than you were in the savings account uh, for multiple reasons. But really, it's all the background benefits that you get along the way. Yet you still have the complete flexibility that you would otherwise have with the savings account. So that's kind of my own personal journey to understanding like why is it like a good thing and why would I feel benefited by borrowing against my policy?
Yeah, and I had those similar kind of internal conversations when I was wrapping my head around whole life insurance and the infinite banking concept. I'd say one of the key things that was an epiphany moment for me when I was reading through, Nelson's book, Becoming Your Own Banker, and he talked about economic value add, this concept that money always has a cost, one way or the other. You're either you're either using it to gain interest, or it's gain interest in an investment or gain interest in some kind of a fund where it's getting a rate of return. Or if you're not using it or utilizing it, it's losing interest. So the idea that having your money sitting in a savings account getting 2%, where it could be getting an internal rate of return of 4.9% in your whole life, life insurance policy, like that's really money is always you're always making money or losing money. And so once I got my head around that concept, then I just looked at the two assets and I said, okay, well, I can get a modicum amount of interest on my savings. So then it was, well, do they both have liquidity? Yes. Do they both have rates of return? Yes. And so once I kind of, okay, but this one has a death benefit. So that's a benefit. I look at you can see the internal rate of return of your policy and it has these guarantees and growth. What's the internal rate of return of this policy? That's better than what I can get in a savings account. Like it started to become a no-brainer, and then it starts to become, well, why doesn't everybody do this, and why haven't I heard about this before? That's kind of like the natural progression of it. Um, and then and to get a little technical, like Derek mentioned earlier, I think it's really easy. I think the way to think about life insurance, we talk about like infinite banking concept, and we could talk about early cash value. It's really just simplify it. Just think death benefit. That's the key to everything. When you pay your premium, you purchase death benefits. So you give your money to the life insurance company. And the thing is, once you pay your premium, the money you've paid for your death benefit, it's technically it's not an asset, but it's backed by assets, right? So it's a thing you are acquiring. You're purchasing it. It has value. The death benefit that you purchase with your premium dollars has a present day value to the insurance company. So that if you walked away, it's the money that they would give you to leave and break your contract. Because once you pay your premium, the insurance company is on the hook. They're on the hook to make that contract good. And so they're in for a lot more money if you pass away than if they just let you walk away. So there's a value to them that if you would agree to break the contract and leave, they will give you this amount of money. That's your cash value. And so every time you're purchasing death benefit and your death benefit's increasing every year, the insurance company is on a higher and a higher and a higher hook every year that they have to, an obligation that they have to pay. That's why your the present day value of your cash flow is increasing because your death benefit's increasing. And so that's what you're doing is it's a contractual right that you have to access that present day cash value. And we prefer doing it through policy loans, in the beginning, and we maybe we're withdrawing up to your cost basis in later years. Well, we can get into that later, but that's really the way to think about it. Is just every time you make a premium deposit, premium payment, you're purchasing death benefit. That death benefit has present day value that you can leverage. So when you're paying, it's not your money, it's the insurance company's money, but you have the right to borrow against it. And that's a great thing because you have all the control on the repayment terms. You can decide not to even pay it if you don't want to. but you have all the control. And it's just a really powerful tool once you really, it's very simple. But once it clicks, once the value of money clicks for you, you'll realize you get the same benefits, oftentimes better internal rate of return plus all the extra benefits. It's just a no-brainer.
Yeah, the way that I like to think about it is, John, as you were describing, compared to what, what's the alternative saving strategy? And as you said, most people, it's just a savings account, right? There may be some other sophisticated, 1 year, 2 year certificate of deposits or high yield savings accounts, those sorts of things. But the important thing to think about is the time value of money. Money sitting in that account. What is the value of that money worth, or the purchasing power? What's it capable of doing over time? And as all Americans know, the effects of inflation are real. The purchasing power of our dollars have gone down steadily for many, many decades, right? And so even year over year, think back to 2021 or 2022, when the stated inflation rate was, 7 or 6% year over year. So that's as if you were putting in $100 into your savings account that year and you just left it. The next year you access it and you want to buy something. Well, now you can only buy 94% of what you would have been able to purchase beforehand because of the erosion of the purchasing power. So how does infinite banking or family banking mitigate against that risk? Well, it's because there's a growth rate, an internal rate of return inside the whole life insurance contract. So every year it's continuing to increase in value, ideally, at least a bare minimum, to offset the effects of inflation. So if inflation was 2 or 3% that year, you would hope that your policy would return at least that 2 or 3%. And oftentimes it does that and above and beyond. And so when you're comparing your saving strategy as an infinite banking person or a family banking person compared to the next guy down the street, you're going to be money ahead over many, many years, decades, generations. Think 3, if not 4 to 10 generations from now, the wealth that has grown and accumulated inside your family system, because it's not being eroded as quickly as everybody else's purchasing power. Now, of course, the dollar is not the perfect form of currency, but it is very powerful. And if we can ever decide as a country to stop inflating and printing money, then everybody will be better off. But this is at least a way to mitigate against that risk of the erosion of your purchasing power by saving inside of a whole life insurance contract, the way that we style it here, and then access it when you need to go and purchase assets, things that will improve your family's wealth planning. So that's my short spiel about why would I want to borrow from the insurance company?
Yeah, and
doing it this way, you're preserving purchasing power.
Yeah, that's a great way to put it. Like, you're losing dollars. Yeah, and every dollar has a velocity to it, whether it's up or down, of gaining for you and working for you, or losing. And that's a really good way to put it. And another maybe common parallel that I think helps a lot of people understand it, and that helped me as well, that many people are comfortable with, is accessing the equity in their home.
Yeah.
Say your home is $500,000 and you put 20% down and your equity is 100K, right? Like, you don't have access to the full 500K of the value of your house, but you can if you are able to apply for a home equity line of credit or a home equity loan. Or lots of people are totally fine with restarting their 30-year clock and cashing out and refinancing. So really, the way I see it is as a parallel is like your death benefit equals is parallel to your market value of your home.
Yep.
Or mortgage payment, or excuse me, let me go the same structure here. The premium payment is the same as your mortgage payment, and as you do both, you're building equity. It's called equity in a home, and it's called cash value in a life insurance policy. And so many people are okay accessing the equity in their home because they know it is like a valuable, tangible, real asset that they can access. It's the same thing, like, but far more simple. You don't have to go hat in hand to the bank to get access to that equity. You can just be the contract owner and access it as you want at probably a way more favorable rate. Um, Plus, again, you're getting tons of other protections. So that's how I've kind of structured it in my mind to help explain it. It also just help understand it that you're accessing something that you're building equity to, just like a home. And nobody would argue that, it's a good thing to find ways to access the equity that you build in your home. Um, but we're finding maybe some just misinformation out there or just common misperceptions of accessing the equity in your policy, aka your cash value.
Yeah, that's a great analogy and very, apropos. Like it's a perfect analogy. But I th we've taken we take so much like comfort in the equity we've built up in our house for some reason. And what I want to illustrate now a little bit is, but that you got to be careful about that comfort because if your house gets destroyed, that equity's gone. If you lose your job and you don't have any way to pay back the line of credit, they won't give you one. I mean, there's so many reasons why the bank might the economy crashes. They might freeze your line. And so if you are someone who's watching this and you have equity in your home and that gives you that sense of peace, just there's some risk there that you need to really be aware of because if that's your fallback, when stuff really emergency really happens and it's affecting the the banking systems, you might not be able to access that money. And so that's not the case with life insurance. They don't care what it's for. You call them up and say, I need $10,000. They just say, where do you want me to send the check? Like they don't care if you pay it back. You don't have to prove anything because the collateral is your debt, the cash value and your death benefit and the death benefit, that's your collateral. They know they're going to get their money back. So I sleep much better at night when I have my equity built up inside of my whole life insurance policy than I have in my home because it's a much more stable, secure place than your home will ever be. And so I just love that analogy. But if you're watching this and you see that clicks for you, that's one of the really great benefits of the cash value that builds up in your whole life insurance. You can access it just like just like a home equity line of credit, but you have none of the rules or restrictions and way less risk.
Yeah, it's so interesting when you're thinking about the term equity, it's like should you use it? What's the headaches and the risks potentially involved when you're tapping into something like home equity? I think the jury's still out on it. I mean, there are some investors that, any form of equity that they have, they want to try and cycle it and utilize it as quickly as possible so it can go and make them more money. And yeah, that makes sense on paper. But then there's a lot of other successful investors that just say, no, I don't feel the need to continue to borrow until I die type strategy because I don't want the headaches that are tied with it. John, you were talking before we hit record about lifestyle. And I think that has to be included in the conversation of a savings strategy and how you finance your assets. You want a strategy that mitigates the amount of hassle on your life. And doing it with IBC or infinite banking is the most stress-free one can be, in my opinion. So,
yeah. The another thing too, just a way to look at it is if your home equity, if you have the ability to access it, and like you said, Derek, a lot of people they just want to use up every piece of equity they have because they might get a higher rate of return on it somewhere else.
yeah.
That's not a bad idea.
Mm-hmm.
And so I've even heard the argument too that your whole life insurance cash value, go to other sources first before you go to that because the insurance company will never not let you get your money, but the bank might. So it might be smarter to get your equity out of your house and get that working for you and leave your cash value as that place you go when the banks won't give you money anymore. And so but the cool thing about that is it gives you that option.
Right.
If you don't have that cash value, you don't have that option. All you have is the banks.
Right.
And the banks don't want to give you money. Now what do? You can't get it anywhere else. So it's just adding that control, adding that option, adding those guarantees, adding all the benefits that you get with whole life. It's just, there just isn't another product out there like it.
Yeah. Very good. That's a good way to phrase that. You need to become your own banker because you may not have that access at some point, or you may not want to borrow from a bank. I mean, I've been looking at some small business loans right now at north of 11%, and it's just like, good grief.
Jeez.
That's brutal. It's brutal. So, all right, John, any final thoughts from you before we wrap up today's episode?
Honestly, no.
Well, I hope our listeners got some good value out of our conversation here, guys. I know that it's certainly provoked some thoughts for me, but I'd certainly like to hear from our listeners. If you are interested in becoming your own banker and starting a policy that we design for you and work with you to optimize for your family finances, be sure to reach out to us at thefamilybankingshow@gmail.com, and we'd be happy to sit down and schedule some time. All right, guys, we'll see you in the next episode.
Thanks.
Yep. See you guys. Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.